Welcome to this month's Big Picture episode of the Michael Yardney Podcast. That's where Pete Wargent and I dissect the multitude of macroeconomic factors that are currently shaping our housing markets and the broader economy. And there's lots to discuss today, including the latest inflation data, what the RBA's interest rate decision means for the future of interest rates in our housing markets, and other data as well. So I'm looking forward to Pete's insightful slant on what's happening, whether you're an investor, a homeowner, just curious. Our monthly deep dive promises to keep you informed and ahead of the curve. So, without further ado, let's dive right into the conversation.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I'm delighted to have Pete Wargent join us again as one of Australia's most respected financial analysts and commentators. Pete brings his invaluable expertise to help us navigate through all the changes happening in the economy and our property markets. Welcome, Pete.
G'day, Michael. Great to be on, as always.
Well, Pete, I know the media's got to do its job and it's always easier and more interesting for them if they can peddle bad news, but it doesn't always give their readers, their listeners, the viewers a 100% true story. And we know this month the Reserve Bank held interest rates steady, but the news outlets had a lot of talk about they left the door open for future interest rate rises. But in my mind, the truth is the Reserve Bank Governor didn't slam the door on rate cuts later on. Basically, I think she said wisely she didn't rule them in or out. I mean, it would have been wrong for her, in my mind, to say we're going to have interest rate falls already, because that would have started people borrowing, started people buying, and that would have been inflationary, Pete.
Yes, so just to recap here. So inflation being the main issue here. So we had a number of years where Aussies got used to very low inflation. In fact, we were actually under the inflation target for half a decade there, under 2 to 3%. And then because of the pandemic, the stimulus, the lockdowns, all the disruptions to supply chains around the world, we suddenly got this big spike in inflation. So it looks like the interest rate hikes have done their job, though. And in fact, in the December quarter, inflation fell much faster than expected. It was only 0.6%. So actually, looking ahead, it looks like the Reserve Bank is more or less done. Now,
so let's just put that in context. Over the year, inflation was 4.1%. So inflation was still there, but it only grew by 4.1% compared to December 22 quarter, a year earlier, where it was 7.8% growth. So a significant fall in the rise of inflation, if we can use a double negative, if that's the right word.
That's right. And some of those bigger numbers will drop off, year on year. So, and if you look at the drivers of it, if you look at the sort of components of inflation, what's really left? You've got tobacco excise, which is nothing to do with interest rates anyway, it's just taxing smokers. Rents are still quite a contributor to inflation. Also, new dwelling costs are still rising. There's things like insurance have just stuck around. But I suppose if you break it down, the tradables inflation, so the inflation that's driven by overseas factors, is absolutely plunging. There's still a little bit of inflation sticking around in the local economy, in services and things like that. But yeah, look, overall, if you went back to 3 months ago, inflation has fallen much more quickly than we thought it would back then. And you can see the change in interest rates, the market pricing for the next 18 months, looking for a couple of interest rate cuts this year, potentially, if you look at what markets say, not what the Reserve Bank governor said in the press conferences. And if you look at all of the major banks are expecting interest rate cuts in 2024. CBA looking for 3 cuts this year and 3 cuts next year. I don't know whether that will happen, but it seems that we're pretty much in the peak of the cycle now and maybe on hold for the next few months, but we'll see what happens in the second half of 2024.
Well, looking back in the past, I guess that's the only way you can look back, it seemed that on average it was 10 months between interest rate peaks, Reserve Bank interest rate peaks, and when they first started dropping interest rates. And in general, interest rates fall more slowly than they go up. In other words, month after month, the Reserve Bank raised interest rates for much of 2022 and part of 23, but it's more likely that the Reserve Bank is going to drop interest rates and then leave it for a month or two to see how things are going. But separate to that, sentiment changes on a dime. That changes very quickly once the sense is that rates are going to come down. I mean, let's just remember what happened, how sentiment changed in 2020 once COVID seemed to be under control, 2019 once the election showed that we weren't going to have changes to capital gains tax. Buyers and sellers hopped into the market very quickly, didn't they, Pete?
Yes, and in particular, in an environment where stock listings, properties listed for sale, are very low, well, the number of buyers in the market will change much more quickly than the number of properties for sale. In fact, I'm sure you've seen this at Metropole in the early part of 2024. It's just a very positive start to the year. I think a lot of people are sensing that interest rates will fall over the next 18 to 24 months. We've got tax cuts to come from 1 July. Borrowing capacities will go up. First home buyers are desperate to get into the market whenever they can because rents are very tough. We've seen some big increases in rents, particularly in Sydney and Brisbane, actually everywhere, to be honest. Perth is all over the place. I think there's a lot of competition building. And if you look at, there's always the usual December, January seasonal thing. But if you look just the big picture, the properties for sale around the country, a couple of 100,000 listings. But if you went back to, say, a decade ago, there'd be nearer 400, and so we've got a bigger population, fewer properties for sale. So competition is going to be quite intense, I think, for good quality properties this year.
And buyer sentiment turns before seller sentiment does as well, so the imbalance gets a bit worse. I know last year my sense is that a lot of people didn't move because there wasn't a level of properties, as many properties to buy, as you say. We've got to remember that we tend to think as investors, but 2/3 of the sales occur to owner-occupiers, and many of them are discretionary. They don't have to move. So they see what the market's doing, what they can move up to. But we're just talking about what's ahead for interest rates. There are also those commentators out there saying that a rate cut may happen even sooner. They're talking about the lower economic growth, the poor spending, retail spending in December, even though I think that was brought forward to November with the Black Fridays. They're talking about unemployment creeping up. So there's still people out there saying we're going to have a rough time and the Reserve Bank better be careful we don't fall into recession, Pete.
That's the flip side, isn't it? Lower interest rates are usually delivered when the economy is slowing, the unemployment rate is rising, and so on. At the moment, we're pretty lucky. Unemployment is under 4%. But yeah, that's the other side of the coin, is that the economy starts slowing significantly. It's pretty sluggish already, to be honest. But if it starts slowing significantly, that could catalyse interest rate cuts. But I think for property people, you want to try and see the macro picture here, the big picture, and that is, well, that's the name of the podcast for one thing. But if you're looking, maybe 18 months, 2 years out, well, we'll have lower interest rates than we do today. That's what markets are pointing towards, and in fact, over the next few years. So, yes, I mean, there'll be a lot of debate over, the timing and the quantum of interest rate cuts. My sense is they could get pushed out a little while into the second half of the year, just because the economy's held up. Inflation's just still sticking around in various parts of the economy. But when the cuts come, they usually come in pairs. So we'll see. They'll double tap.
Yeah, let's see. Now, we spoke a couple of times about rent, and earlier this morning I was just reading a report from CBRE, the International Estate Agency. It came out last year about rents and apartment rents, and they were suggesting that apartment rents are going to grow 26% between now and 2028. Pete, we've on previous occasions spoken about the lack of supply, the lack of pipeline of new apartments. We know it's going to be very expensive to build new apartments. And we know the government's actually suggesting that we've got to densify, we've got to build more of these apartments, high-rise towers. But I can't see that solving the rental crisis. If you take land in the most expensive parts of Australia, which is where a lot of these apartments are happening, and then you add the most expensive construction costs, it costs a lot more to build apartments than houses, and you haven't got people wanting to buy them off the plan, it actually doesn't make a lot of sense that we're going to be able to deliver many apartments in the near future.
Not for the next few years. I mean, the government has announced a target of 1.2 million dwellings in 5 years, but whether or not that can actually start happening soon. I mean, we've seen insolvencies. There's another big construction giant went down just recently in Sydney, 20 projects halted, a huge pipeline of work under the QBC now thrown into doubt. And that's just one story. I guess it's representative of a wider picture. Construction is not profitable at the moment. Development is, a lot of developers have got projects that were signed up under fixed prices, and materials costs have gone up, trades costs have gone up under the shortages. We've got a lack of foreign buyers. That's not helping pre-sales. We've got a lending assessment buffer, which is 3 percentage points. That's not helping pre-sales. I think, to be honest, I think development will only really pick up when unit prices rise. I think that's the thing that will spark the rebound in construction for apartments. At the moment, approvals are very low. Really, if you look at the past year, 2023, 160,000 approvals, but 1 in 4 new builds is a knockdown rebuild. So that's only replacing existing stock, said the HIA. So that's the lowest in over a decade.
And of course, a lot of approvals don't actually even come out of the ground for the reasons we just said.
Yeah, and I think that's it. And also medium and higher density stock, it takes 2 to 3 years to really bring it to market. So if you're looking for, the next cycle peak for construction, or for at least for apartment supply, it's not going to be until 2026 or 27. So over the next few years, I mean, we're already seeing some big rent increases in some parts of the country and a lot of competition for good rentals. So, I mean, these things tend to work in a cycle, but it's going to take quite a long time before we come out the other side of this one.
Well, CBRE's report said that vacancy rates will fall to 0.8%. That's a bit less than the 1% we got now. In other words, you really can't find a property at the moment, and that means that rents are going to keep increasing just because of supply and demand. They're suggesting that over the next 4 years, between now 2024 and 2028, in Sydney, they're going to be delivering about 14,000 new apartments. Now, that sounds like a lot, but it's well below the 33,000 per annum that's needed. So the vacancy rate's going to go down and rents are going to go up. Melbourne, we're going to only deliver about 10,000 apartments per annum over the next 4 years, 40% below the levels in Sydney, when in fact we probably need closer to 40,000 a year. So rather than 40,000, we're going to be delivering 10,000. And this is going to drive down vacancy rates, push up rents. An apartment in Brisbane, not as many people live in apartments there. The CBRE are forecasting that we're going to deliver 6,500 per annum, when the requirement is probably more like 3 times that. So I guess what I'm suggesting is that rents are going to keep rising, but when these new apartments do come on the market at much higher costs, it also means that it's going to drag up the price of established apartments. We know apartments really haven't performed as well, and there's a whole range from those high-rise towers with building issues that we don't want to buy in, to more family-friendly apartments. But there's an inherent equity in these apartments when replacement costs are so much higher, Pete.
I think that's right. If you look at the vacancy rate figures, Domain puts out a rental report, and in early 2024, they've got vacancy rates at an all-time low on their data series. So now Sydney was under 1%. That's the lowest they've had before, and they had the highest number of views per listing. But it's actually the same. If you look around the country, Brisbane's under 1%, Adelaide, Hobart, where vacancy rates have fallen again, Perth is under 1%. So yeah, there's some parts of the country. I guess that leaves the other capital cities like Canberra and Darwin, but basically record low vacancies. And as you said, I think the new stock, I mean, we can actually start to see it in some, you don't get many adverts at the moment, but just the pre-sales for new apartments, you can see they're coming on at much higher prices. And it's only really that stuff that is really stacking up for developers at the moment. Even one-bed apartments in Sydney over $1 million. Most of the sort of generic stock is just not stacking up. So that's why I think developers just can't make all that many projects feasible at today's prices, and they're just sitting on the sidelines.
Well, I know you own apartments and I own a number of apartment blocks, so they haven't performed well over the last decade. They have in previous times, and I'm looking forward to some good times ahead. And I guess that's the way investors really should think. What's the market going to look like? What sort of property is going to be in continuous strong demand in 10 years' time? Not really what interest rates are going to be at the end of this year, Pete.
Yes, yeah, you're right. I've got a few apartments in Sydney. I think also in Brisbane. I bought during the oversupply about 4 or 5 years ago in places like New Farmer. I think, as you said, the stuff that's tended to do well, and the AFR did a good piece on this recently. It's generally in Sydney. It's places like where you'd expect really Tamarama, Bellevue Hill, Bondi. The places where there's 3-story height limits. Affordability is very constrained. The stuff that's done really badly is the high-rise towers in some of those sort of conurbations in Western Sydney and Parramatta and stuff, where I think a lot of people paid top dollar at the peak of the last cycle and really haven't seen any returns at all. I think generally in property, everything works in a cycle. Perth had 10 years there where nothing happened, and then suddenly you get a spike, and same for apartments and units in Brisbane. Everything gets its day in the sun. But generally, for units, there's really 2 different types of property. There's the stuff that people really want to live in, and is in short supply, which is really the boutique developments in places like the eastern suburbs in Sydney, and Melbourne's got its own equivalents. And then there's the high-rise towers, which are more, they tend to be sold to offshore investors and landlords and things like that. They tended to underperform because of the lack of scarcity.
Now, a report by Nerida Conisbee, chief economist of Ray White, got a bit of publicity, including, as you were saying, in the AFR, and she was pointing out that luxury houses and luxury apartments had far stronger growth than the rest of the market. Now, I know there are people out there saying, you can buy any property, everything increases in value. That's not really true, and I think moving forward this next couple of years, our markets are going to be fragmented. Sure, 2-3 years ago when interest rates were virtually zero, and anyone could borrow, the lower end of the market did well. People bought on main roads, secondary locations. But there seems to be a flight to quality. And Ray White, in some clever charts, or the Nerida Conisbee on their behalf, confirmed that the top 5% of houses and apartments outperformed over the last decade. Now, I'm not necessarily suggesting they're investment grade properties because they tend to be a bit more volatile. The market's a little bit tighter. But I think more affordable suburbs are going to have some issues because they're going to be hit more by the relatively higher interest rates, the cost of living. So I'd be looking for investing in the next little while, but it's always been that way, Pete, at where people's wages are going up more than average in gentrifying suburbs.
Absolutely, yeah. And if you look at the list, actually, the luxury homes that have outperformed over the decade, lots of familiar suburbs in there. In Brisbane, places like New Farm and Paddington, Sydney, inner west and eastern suburbs, and so on. So, it's practically what you've always spoken about, really. It's the areas where people where bankers get bonuses, or people have equity and stock portfolios and businesses and all that kind of thing. More so than the sort of working mortgage belt suburbs where the higher interest rates will bite harder. I think if you look at some of the stats being thrown around, there was a Fin Review piece there where unit prices have tripled in some suburbs over 20 years. But I think sometimes you've got to be a little bit careful with some of this data because they've got in the list here Erskineville, Alexandria, Redfern, Woolloomooloo. I do wonder whether some of that is just due to areas where you just had some older units and now you've got this big supply of newer apartments at obviously higher prices. And I think sometimes that like-for-like property sale capital growth is not quite as high as implied by some of these numbers. And because it's what you always talk about at Metropole, but you really need to look for that scarcity value. And yes, the capital growth you read in the property magazines and things like that, you just got to be a bit careful with some of the data.
Well, there's not one Brisbane market or Sydney market, and there's not one Sydney apartment market. High-rise towers, the ones in Bondi and Coogee overlooking the beach, there are the old mini Art Deco apartments as well. So you're right, and you really do have to go down much more granular rather than the big picture discussions. But I think in principle, though, some areas are always going to outperform. Is that fair? Well, the rich are getting richer, and I think they're passing a lot of their wealth down already with a warm hand rather than the cold hand. The bank of mum and dad's helping a lot of people into the market because the rich have got equity in their properties, Pete.
That's probably one of the biggest trends I've seen over the past year is parents. I think actually McCrindle had for one of their trends for 2024, the bank of nan and pop. So not just the bank of mum and dad, but...
Well, I'm paying my grandkids' school fees, and that's very expensive, Pete.
Yes, it's the intergenerational wealth transfer. I think Bill Perkins talked about this in his book, Die With Zero, is that if you accumulate loads of wealth and oversave for your retirement, well, if you pass on an inheritance, you've got no control over what happens to those funds. Whereas if you can strategically use some of your equity or wealth while you're still alive or in retirement, if you can help the kids onto the property ladder rather than being stuck in this very tight rental market, that's become very popular in the last year or two. So we've talked a lot over the years about the intergenerational wealth transfer. Well, it's happening now. You can actually see it in real time. Yes, as you said, the premium areas have outperformed in recent years. We've got stock markets back at record highs. So superannuation balances have grown for the wealthier households. So yeah, but that is now starting to flow down to the next generation and the next. So there's definitely sort of a growing inequality, a wealth inequality that is an issue in Australia because we don't have punitive death taxes.
We're losing the middle class in some ways, and the fact that rents are going up as a landlord, I like the idea, but I don't like the concept that people can't find accommodation in Australia. That's not right in the country that we live in. Now, we're talking a lot about these big picture thoughts rather than where the next hotspot's going to be for 2024. And that's one of the themes when you and I are going to be getting together in a little while at Wealth Retreat, also on the Gold Coast at the end of April. We tend to talk about long-term perspectives. That's because successful investors, strategic investors, don't think about this weekend or next year, but they plan their lives where they're going to be in 5, 10, 15 years' time. And the theme of Wealth Retreat has always been, Pete, where am I going to be in 5 years' time?
As soon as you said that, you could see a little smile creep over my face. I always look forward to having a week on the Gold Coast, not just because of the golf and going to the beach, but because, as you said, it's a time to step away from day-to-day business and everything else that gets in the way of your planning and goal setting. And one of the things I always come away with is a little to-do list of things that I must do over the next year and mustn't do. And then I get an accountability partner. Somebody like Mark Creedon is good to keep you accountable. But for me, things like learning to delegate, I mean, that's something that came up a couple of times over recent years for me at Wealth Retreat. And I've found, I've got people now can pass on admin too. It's just like a lot of people, I like to do everything myself, but that's not the way to a wealthier future. There's so much you're going to get out of that week. And I always, I've lost track of how many years I've been going. I think 8 now. So nearly a double digits.
Well, it's not just the faculty, and we've got a great faculty this year. Mark Bouris, the CEO of Yellow Brick Road, is going to be there talking about the Mark Bouris story, how he actually achieved what he achieved. There's you, Andrew Wilson, talking about the economy and property as well. A special presentation from Stuart Weems, Hung Choi, a strategic finance broker. So a lot of the regulars, but a whole lot of new people. We've had to, because the world's different. But I see this as a year of opportunity. We've got a window of opportunity at the moment to get set for the property market moving forward. But more than that, it's also a great opportunity to just hang out with other people. This is the common theme that people who come to Wealth Retreat tell me. Their current peer group isn't the right one to get them to the next level. So yes, they need knowledge. Yes, they need information. So they go in with ideas, thoughts, but they come out with firm plans, and everyone has a one-on-one implementation session with me. But it's also the network that you develop, isn't it? That's really a great part of it.
Sure is, yeah. I mean, I'm still in contact with so many people I've met at the Gold Coast over the years, and it's great to mix with like-minded people, I suppose, aspirational people, where talking about money and wealth and future plans and goals is not a dirty word. It's something we can all get stuck into.
Definitely. So if you're keen to join Pete, me, and the best faculty I could put together, don't count yourself out. Don't think maybe it's not right for me. And don't say I'll go next year. Everyone says that. It's action takers are the ones who get further in life. Go to wealthretreat.com.au. By the way, you can't just book in. I speak to everyone who wants to come to make sure it's suitable for you. And I'll back you if you're prepared to back yourself. I'll back you with my money back guarantee. And I'm prepared to do that because no one's ever taken me up on that. wealthretreat.com.au. Now, I'll leave a link in the show notes. Now, Pete, one of the other bits of news over the last month was Australia's population reached 27 million people. That was decades before some of the very earlier predictions. Our population increased by 624,100 people over the 12-month period, equivalent to more than the entire state of Tasmania just in 1 year. But if we look forward, if it keeps growing at this rate, Australia's population will be 41 million people by 2042. That'll be 16 million more than the 2002 forecast by the government. This is also creating some challenges, though, isn't it?
Yeah, massive numbers, aren't they? So, yes, I mean, permanent and long-term arrivals into Australia over the year to November, which is the most recent ABS data, 1.085 million. So nearly 1.1 million. That's by far and away the biggest number we've ever seen. Now, of course, some people are leaving the country as well now, and they weren't able to for a period of time, about 440,000. But if you net it off, we've seen the highest net immigration we've seen in recent history. I think we're probably round about the peak now. If you look at what the population clock likes to try and project, about 1,700 people a day. So if you extrapolate that out, I'm not a walking calculator, but 630,000 or something like that a year. So we're still running at red hot levels. I think eventually this will start to calm down. A big part of the story has been the return of international students. We've got over 600,000 now. There'll probably be a bit more political pressure actually to slow things down over the next year or two as well. I mean, Treasury predicted for this financial year net immigration of 375. Well, it's going to be undercooked. I think population growth it's becoming a hot topic just because people can't find somewhere to rent. We see on the Sunshine Coast all the time, people are posting on the Facebook pages, I can't find anywhere to stay. This is not a healthy dynamic. It's a record high demand for property. And as you said, we've really got ahead of what was predicted a few decades ago.
A couple of things come out of it for me. First of all, we know that most people who come to Australia, these immigrants, rent for the first 3 to 5 years. They're finding out where they want to live. So all they know when they come to Australia is where their job is or where their university is or maybe where their community from the country they came from is. But after a period of time, many of them have got the aspiration. That's part of the reason they came to Australia, to live, which means to me there's a whole heap of current tenants who are going to come into the property markets to buy 3, 4, 5 years, maybe even sooner down the track. That's going to help underpin property values. But the other concern I'd like to get your thoughts on is the soft infrastructure. We're talking at the moment about houses and we haven't got enough, but what about the roads? For every million people that come, apparently there are 600,000 cars. What about the water and the sewerage and the hospitals and the schools? We're just not building enough.
That's the multiplier effect, I guess, of growing the population. People say, well, as more people are renting, then the balance of power will tilt because more people will vote for, a change in housing policies. But I think people have misread that. If you look at the people who come to Australia, it's a different immigration program from other countries, largely skills-based. If you take the international students to one side, and it's aspirational people, largely now from India, on a permanent and long-term basis. Previously, China was the biggest country, but as you said, people they get their foot under the table, so to speak, once they move here as renters. But as soon as they can, people like to buy. That is just the nature of it. And you don't have an airport train in Melbourne, but of course, whenever you arrive and I get into the taxi, first thing the taxi drivers talk about, what are you here for? They tell me about where they've bought, often they're landlords themselves. I just don't think that those trends are going to change too much. If you look at home ownership rates, they haven't fallen in recent years. I think first home buyers who are able to buy are buying. Intergenerational wealth is fueling that to some degree as parents help their kids onto the ladder. Overall, home ownership rate in Australia is held up, and I think people are still aspirational and still do want to get onto the ladder generally.
Sure. One last thing I'd like to have a chat with you about is the latest housing finance figures. I'm interested in those because I see them as a leading indicator for our housing markets. In other words, people go to their mortgage broker, people go to their bank and get approvals in advance. And the figures for December, the most recent ones from the ABS, showed there was a fall in housing finance new loan commitments, Pete.
Yes, I think sometimes you just got to get a bit granular on this stuff. There was a massive jump in October. Then we saw another positive month in November and a bit of a pullback in December. But basically, the trend is higher. And if you were to compare to a year ago, well, it's more than 20% higher. Property searches online for property investment, those searches have increased. I think as well, when you drill into it, why the fall, I suppose, in December? Well, part of the reason is lending for new homes and for the construction of new homes is at record lows. Yes, there's different parts to the lending market. The average loan size, I noticed in December, hit a record high. Yes, if you look at investor credit growth last year, it was a bit strangled because some investors were selling. But now we're starting to see some investors getting interested again. So, yeah, there was a bit of a pullback in December, but the trend is up and investors will be up this year.
Well, I think we've noticed, and we spoke beforehand, you deal with investors and so do we at Metropole, that there's a sense that this is the year to get set, a window of opportunity in the market now before interest rates start to fall, before confidence increases and more buyers get in the market. You can't just buy any property, of course, but it's a good time to get all your ducks in a row and get ready. And once a month, we're going to get together and keep talking about these big picture thoughts, Pete. But if people want to keep in contact with you between now and then, how do they get in contact with you?
You'd most likely phone me on the golf course at Noosa Springs for the next
hang on.
months,
Pam told me to remind you, because she knew we were chatting today, to set aside the Thursday after Wealth Retreat for golf, because we missed it last year. So, yes, she's looking forward to a game with you.
We did, yes. The pandemic threw a few of our old habits out of kilter. But apart from the golf, you can get me on my daily blog, Pete Wargent Blogspot, or various other places on the interweb, social media. I'm on Twitter daily at Pete Wargent. Yeah, I'm always happy to have a chat, so book in a call.
Well, I will leave a link to those things in the show notes and look forward to catching up with you again real soon, Pete.
Yeah, can't wait. Thanks, Michael.
I hope you enjoyed this month's Big Picture podcast with Pete Wargent. I always enjoy my chats and his insights. If you're one of the many people who listen to this show but don't currently follow or subscribe, please just stop for a sec before we have the next couple of segments, and on whatever podcast app you're using, just follow this show so that twice a week you get the regular expert commentary from my guests and myself. Oh, by the way, it'd be really great if you took the trouble to leave a review as well. Now, two things came out of my chat with Pete. In my mind, one big lesson was that there's currently a window of opportunity. Our markets are offering those who are financially ready to do so a great time to buy their next home or an investment property. And that's because currently properties are, I guess, below replacement value. You couldn't replace most apartments or townhouses or even homes at that price, the current price. We've got three big factors underpinning our housing markets in the long term: a significant growing population, strong jobs growth, and increasing wealth in our nation. So we're at the beginning, still a year into a new property cycle, something that doesn't happen often. Now, I'm not suggesting you try and time the market. That's too difficult. In truth, you've missed the bottom, which occurred early last year. But if the market hands you an opportunity like this, why not take advantage of it? But of course, you can't just buy any property. And that's why I'm going to recommend, if you're interested in growing your wealth through property, you have a chat with my team at Metropole. It all starts by putting a strategic plan together for you, and then implementing the plan will help you become, or I guess we help you plan to become the people you plan to become, so that you outperform the averages safely and grow into generational wealth. Now, the other message that came through a couple of times in my chat with Pete was the Power of Wealth Retreat. I know every year Pete sits at the back of the room planning out the next stages of his life in business, in property, in all sorts of areas. And that's the theme of Wealth Retreat. Where are you going to be in 5 years' time? But it's not just the faculty, as we said, it's who else you speak to. The conversations at breakfast, lunch, dinner, morning tea, the late evening conversations. What would it be worth to you to get into a room of movers and shakers? We've got a great faculty, but we've also got a great number of delegates coming. I know that because there's quite a number of people coming back for the second, third. There's 3 people coming back for their 4th time. And you'd ask, why would they do this? Why would they come back again? But while the questions are the same, the answers are different. The world is different. So go to wealthretreat.com.au, find out all about it. You can't book in. All you can do is register your interest so that I have a chat with you to make sure it works for you. Because I'll back you if you're the right person to join our faculty. And don't count yourself out. If you're the right person to join us at the event, I should say, not our faculty, I'll back you with my money back guarantee. Happy to do that because no one's ever called on it before. Wealth Retreat at the end of April.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a letter written by the late George Bush, the 41st President of the United States. When he died in 2018, a letter of advice he'd written to young people did the rounds of the internet. Now, you don't have to be a young person to appreciate this advice. In fact, I think it's excellent advice for all of us, especially at this time of the year. The letter said as follows: I can't single out the one greatest challenge in my life. George Bush went on to say, I've had a lot of challenges and my advice to young people might be as follows. Don't get down when life takes a bad turn. Out of adversity comes challenge and often success. He went on to say, don't blame others for your setbacks. When things go well, always give credit to others. Don't talk all the time, said George Bush. Listen to your friends and mentors and learn from them. Don't brag about yourself, said George Bush. Let others point out your virtues and your strong points. Give somebody else a hand. When a friend's hurting, show that friend you care. Nobody likes overbearing big shots. As you succeed, be kind to people. Thank those who helped you along the way. And don't be afraid to shed a tear when your heart's broken because a friend is hurting. Say your prayers. And that was signed by George Bush. Well, there are some words from an elder statesman. I hope you found them inspiring. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney Podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney Podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?